If you're selling online in India, you know that GST filing can be a real headache. And honestly, one of the biggest mix-ups is trying to figure out your GSTR-1 sales data versus those TCS reports you get from the marketplaces. Well, today, we're going to clear that up once and for all.
So I hear this constantly. It's a super common assumption for sellers. You get your settlement report from Amazon or Flipkart, you see the TCS numbers, and you think, perfect, I'll just use this for my GSTR-1. It seems like the easy way to do it, right?
Well, let me just stop you right there. That is absolutely 100% incorrect. And relying on that method isn't just a small slip-up. It can lead to some really serious compliance issues, tax notices, and even penalties down the road.
See, this isn't just a simple error. It's a fundamental misunderstanding of how the whole GST system is designed to work for e-commerce. So let's break down exactly why using those marketplace reports for your GSTR-1 filing is the wrong move. Okay, let's dive into this. To really get why this is a mistake, you have to understand that there are two different sections of the GST law that are working at the same time but separately. Let's start with your main job as a seller, which is all laid out in Section 37.
Section 37 of the GST Act is crystal clear on this. It says that you, the seller, are legally on the hook to report the details of all your sales, what the law calls outward supplies, in your GSTR-1 return. This is your responsibility and nobody else's.
And if you take away only one thing today, let it be this. The foundation, the single source of truth for your GSTR-1 filing is not a settlement report, it's not a TCS statement, it's the actual sales invoices that you issue to your customers for every single sale. Period. So what does that cover? Well, as you can see, it's the whole shebang. Your business-to-business invoices, your direct-to-consumer sales, any exports, and even things like debit or credit notes. But notice what's missing from that list? You got it, TCS data. It simply does not belong here. Okay, enough with the legal jargon. Let's make this super practical. We're going to walk through a really simple example so you can see exactly how this plays out in the real world.
So let's just say you sell a product and the base taxable value is 10,000 rupees.
On top of that, you've got your GST, let's say at 18%, which adds another 1,800 rupees.
That brings the total value on the invoice, the amount your customer actually sees and pays, to 11,800 rupees. And here's the crucial point. Your GSTR-1 return has to report a taxable value of 10,000 rupees and GST of 1,800. It needs to be a perfect mirror of that invoice. It is completely, totally irrelevant what Amazon or Flipkart actually pays you after they've taken out their commissions, fees, and whatever else. Your filing is based on the sale, not the final settlement.
Okay, so that's your job. But what about the marketplaces? What's this whole TCS thing about then? Well, this is where that second piece of the law, Section 52, comes into the picture. This part defines the totally separate job of operators like Amazon and Flipkart.
See, Section 52 puts a legal responsibility on the e-commerce platform, not on you. They are required to collect a tiny percentage, specifically 1%, as tax collected at source, or TCS, on the net value of the stuff you sell through their site. So how does that actually work behind the scenes? Well, first, the marketplace figures out your net sales for the month. Then, they take out that 1% as TCS from your payment. After that, they deposit that money with the government by filing their own return, which is called a GSTR-8. And finally, that amount pops up in your GST portal as a credit you can use.
Just to put some simple numbers on it, let's say your net taxable sales for a month were 1 lakh rupees. The marketplace would simply collect 1% of that, which is 1,000 rupees, as TCS. They handle all of this for you.
And this is another really key point to get. That TCS amount, it's not your income. You should think of it more like an advanced tax payment that's been made for you. It's basically a credit just sitting in your account, ready for you to use later to pay off the final GST you owe when you file your GSTR-3B.
So now we have the two big pieces of the puzzle, your role under Section 37 and the marketplace's role under Section 52. Let's put them right next to each other to make the difference absolutely unmistakable. Now, what's really interesting about this slide is how it just simplifies everything. I mean, just look down the rows. Who does it apply to? Section 37 is for you, the seller. Section 52 is for the e-commerce operator. What's the basis for the calculation? For you, it's your sales invoices. For them, it's the net taxable supplies. The returns they file are different. The whole purpose is different. You're reporting sales, they're collecting a tax. They're just two separate parallel tracks. All right, so after all of that, what's the one single golden rule you need to walk away with? What is the one thing that will always keep your GSTR-1 filings accurate?
It's this. Your responsibility under Section 37 and the marketplace's responsibility under Section 52 are completely independent. They operate in their own lanes, and they never, ever mix. One does not replace the other.
So the crucial point is this. Your GSTR-1 filing is built on one foundation, and one foundation only, your invoices. That is always your single source of truth.
So after going through all of this, the final question is really for you to think about. Take a good, honest look at your own process. Are your tax filings actually built on the right foundation?